Okay, so let's start. Thank you very much for joining us today. My name is Anastasia Papas, and I'm the founder of this new nonprofit research organization, the Access Forum. This new initiative was built on the success of all the webinars, 21 in all, we organized during the past year, as well as on the support of the community of 230 economists and policymakers who have joined our Slack platform. The Access Forum's mission is to aggregate knowledge from around the globe with the aim to catalyze the engagement of economists and decision makers who are working on policies towards achieving a sustainable economy. We will continue bringing economists and policymakers together through our webinar series and through building our Slack community. In addition, we have been working on 2 research projects, which we will present today, even though they're still work in progress. The first project is the construction of the Green Monetary and Financial Policies Tracker, which will map the global landscape of monetary and financial policies aimed at mitigating climate risk. The tracker will facilitate the comparison of national policies as well as their effectiveness. The second project is the construction of the Literature on Climate, Macroeconomics and Finance Tracker. This is a structured taxonomy of the literature on climate economics and finance, which will allow interested scholars and policymakers to explore its details in an intuitive manner, as well as follow the evolution of the different streams of research. It will be regularly updated to reflect developments in theoretical and empirical research. So how do these 2 projects contribute towards our mission? Well, a lot of progress has been made in terms of research and policymaking. The bulk of the work still lies ahead. For example, we need more tools for assessing climate-related risks to financial stability. We need modeling frameworks to understand the different scenarios that might arise during the transition to net zero. And that, just to name a few. It is important to bridge the gap between policymaking and theory, because policies aimed at mitigating climate risk have complex effects on the economy, are riddled with uncertainty, and are based on partial data. Because climate change is an unprecedented phenomenon, and we need to rely on theoretical analysis to capture the macroeconomic dynamics from transitioning to a carbon-free economy. Both trackers that we are developing are an effort towards this direction. But to talk more about the challenges policymakers are facing due to climate change risk, I'm delighted to introduce to you our first speaker, Steve Ciacade. Steve is the Rosen Family Chair in International Finance at the Brandeis International Business School. He's a research associate at the NBER, a research fellow at the CEPR, and vice chair of the Advisory Scientific Committee of the European Systemic Risk Board. From 2008 to 2013, Steve served as the economic advisor and head of the Monetary and Economic Department at the Bank for International Settlements in Basel, Switzerland. From 1997 to 1999, he was director of research at the Federal Reserve Bank of New York. Steve, the floor is yours.
Thank you very much. Thank you very much for including me in this important and interesting event. And I am very, very pleased to have the opportunity to support the e-Access initiative, and enjoyed the webinars quite a lot and learned from them. So my subject is central banks and climate policy. Anyone who cares about the future of civilization is concerned about climate change. Avoiding catastrophe means that we all need to act quickly to reduce our reliance on fossil fuels, and hopefully also to find ways to reduce the damage that we've done. This is an enormous task that requires a global effort. But the question is what we should do for individuals in advanced countries. The answer is pretty straightforward. We need to reduce our individual use of carbon. So in that way, I think it's excellent that we're having a virtual seminar and not flying around the world to meet each other in person, as much as we might enjoy that. It also means finding ways to aid those who are less fortunate, to help them improve their standard of living in a manner that's not carbon intensive. That's from the individual point of view. For policymakers, the answer depends on the scope and the nature of their responsibilities. I want to distinguish three parts of the government in thinking about what it is that the government can do. There are fiscal authorities, there are regulatory agencies, and then there are monetary policymakers. And each has a role, and each has a set of tools. Fiscal policy sets taxes, expenditures to influence the structure of the economy and the distribution of income. Regulators establish and enforce rules of the game to protect our physical and financial health and safety. And through their judicial use of their balance sheets, as well as adjustment of short-term interest rates, monetary policymakers work to maintain price stability and promote full employment. So the question is how each of these three groups can address the existential threat posed by climate change. Now, when it comes to fiscal policy, I think the answer is pretty simple. Impose a carbon tax. Every economist agrees on that. And sponsor research and development to reduce the amount of carbon we're pumping into the atmosphere. And if we're lucky, find ways to reduce the carbon that we've already put there. But before I get to regulation, I should say that central banks, the primary subject of what I have to say, have several roles. As I said, they manage their balance sheets and lend to intermediaries and control interest rates. Depending on the jurisdiction that you're in, they have some responsibility for financial regulation as well. Importantly, however, a central bank's regulatory responsibility is logically and usually organizationally separate from monetary policy. But when considering the role financial regulators play in policies that are aimed at mitigating climate change, I don't think it really matters where they are, whether they're like the controller of the currency in the United States that's separate, or whether or not they're the Prudential Regulatory Authority in the UK that's inside of the Bank of England. Now, turning to the financial regulators themselves, they're responsible for guarding safety and soundness of the financial system and for protecting consumer and investors. Climate change has the potential to create systemic risk that jeopardizes those objectives. So authorities really need to act. To start, so the question is what they can do. Now, there are a couple of things they can do and they should be doing right away. The first one is to require enhanced standardized disclosure so that intermediaries tell us what their exposure to carbon producing industries and natural disasters actually is. Now, since climate change is the epitome of a global problem, the disclosure protocols ought to be global. Fortunately, I think international standard setters, some of my former colleagues in Basel, are on the job on this. They're working on it. Maybe not quickly enough, certainly not for my taste, but they are working on it. Second, regulators should actually actively assess the climate resilience of financial intermediaries, especially banks and insurance companies. Again, this is a global problem that requires, I think, very detailed information and technical knowledge. To give you one example, climate scenarios for these assessments are almost surely best developed through international cooperation using a set of experts, based on a set of experts. There's no reason that individual institutions should generate their own scenarios, each separate from the other. Furthermore, I think from the perspective of both authorities and market participants, it's going to be useful to have assessments based on uniform scenarios. Now, here I want to point out that the Network for the Greening of the Financial System, which is a collaborative among central banks, is also on the job. So that's a good thing. Again, slow but good. There are also things that financial regulators, in my view, should not do. Regulators could restrict assets that intermediaries can hold or adjust risk weights on the assets that they do hold. in things like capital requirements and other and related regulatory using related regulatory tools. Now, in those cases, authorities would have to decide what's green and what's not. In practice, drawing lines of this sort is quite fraught and something we normally don't assign to independent authorities. It's way too political. So my advice on that is don't do it. Now, before I come to monetary policy per se, I'd like to make a few additional comments about financial stability. The first concerns there we go. The first concerns the role of incentives in markets in this process. For a financial economist, it's natural to ask why it is that managers of financial intermediaries and investors in those intermediaries aren't doing doing this themselves. Why isn't it part of the internal risk management and part of the information set that the investors want? Now, surely they all have the right incentives, so markets should price climate risks, penalizing those institutions that are most exposed. But I think what we've learned is that there are limits that that can lead to underpricing of this kind of risk, especially because it's so far out in the future. So what about financial stability risks that arise from climate change? What do those look like? Well, it's hard to know how to even start answering this question. We can make a bit of progress by noting that financial crises arise from sudden shifts in prices of risky assets, from what economists think of as movements from good equilibria to bad equilibria. Let me give you two very quick examples. The first is the dot-com boom and bust in the 1990s. A new technology came along, generating euphoria. At some point, people realized that things were not quite as rosy as they had thought. Some degree of euphoria was justified, but not all of it. And when that happened, equity prices adjusted. It's important to keep in mind that equity prices are very sensitive to forecasts of risks in the distant future. So when people realized that things weren't as rosy, then prices moved. I should also say, of course, that this distant future is the rationale for why it is that Tesla has a $700 billion market cap on revenue of less than $40 billion, while General Motors has a $70 billion market cap. I'm sorry, has a $70 billion market cap on revenue of more than $120 billion. My second example, which I think helps understand financial risk, systemic risk, and climate, is the 2007-2009 crisis. There was a large buildup of mortgage-related debt based on unrealistic expectations in that case about the path of residential housing prices. When the debt became sufficiently large and people realized that housing prices weren't going to go up forever, the system collapsed. Now, what does this have to do really with climate risk? My sense is that both the physical climate risk of more frequent natural and extreme weather and the transitional risk associated with large-scale changes in production technologies and reallocations can be a source of sudden asset price shifts. While I would expect some of the climate risk to play out slowly, which doesn't pose a systemic concern, that's not true for everything. And so what's going to happen, or could easily happen, is that there could be an unsustainable boom in the valuation of green assets that could then create an adjustment. Now, that's the risk in the example that I just gave you, that Tesla, one day we're going to wake up and it could be worth 1/10 what it is now. The far greater risk, however, for financial stability, in my view, arises from the possibility of a sudden political decision. Now, you'll all recall, I'm sure, the May 2011, following the Fukushima nuclear accident in Japan, the German government suddenly announced the decision to close all nuclear power plants over the next 10 years. Sudden policy changes like that, which I can envision in this case, you could have an abrupt, however welcome, imposition of a carbon tax, for example, could lead to a swift repricing of assets. This could have an influence on financial intermediaries' balance sheets. So I think we have to build that into some of the scenarios and think about how that would affect our financial system. Now, finally, turning to monetary policy, what most people associate with central banking, I want to return to the three activities that I mentioned: interest rate policy, lending policy, and balance sheet management. I know I'm taking a lot of time, but let me just say that there's something I'm not going to talk about, which is the fact that central banks produce a lot of research and a lot of data. Those are public goods, and obviously in this case, they need to continue doing it and redouble their efforts in the area of the impact of climate on the economy and the financial system. The goal of the first, which is to say interest rate policy, is low stable inflation and high stable employment. The instrument for this, as I suggested, is interest rates, both current and expected future ones. Under some circumstances, this includes asset purchases, but I view these as primarily a mechanism for policymakers to commit to a path for future rates. While climate risk can influence the general price level, a carbon tax would almost surely be inflationary, certainly in the short run. I see no justification for changing the agreed upon framework for monetary policy. In the same way you don't hire an electrician to fix a leak in your roof, you would not ask monetary policymakers to fix climate policy. It's not the right tool for the job. Next, coming to lending and balance sheet policies, on the first, central banks decide on collateral eligibility and haircuts for a wide array of assets. In its main refinancing operations, the Euro system accepts more than 25,000 different securities at haircuts that range between 0.4 and 44.6%. I checked this yesterday. In theory, they could adjust this schedule, both the securities and the haircuts, to promote a green investment. Every central bank has something similar, and they could do this to steer credit to favored industries. Again, I think that this would be a mistake. Turning to balance sheet management, different jurisdictions operate differently. In the United States, for example, the Federal Reserve is restricted to owning securities that are only fully government guaranteed. They can't make outright purchases of privately issued securities, so there's no risk that they're going to buy or not buy green or brown or whatever types of assets. What they can do, however, is lend, and they do that in two ways. They have conventional discount lending, and they also can lend through these special purpose vehicles that are sort of something that I don't think we need to talk about. Now, in practice, central banks use their lending and balance sheet policies. If in practice they did this, should central banks use their lending and balance sheet policies to help reduce climate risk? Again, my answer is no. They would have to decide on shades of green and brown, and then whether to lend and what to buy. Such heavy-handed interventionism would open central bankers up to entirely new type of criticism, putting their monetary policy independence, in my view, at serious risk. Now, to understand why I feel so strongly about this, I want to emphasize that my view of monetary policymakers is that they're in charge of the aggregate price level. They are not and should never be responsible for relative prices. In fact, to the extent possible, they should avoid making any decisions that are inherently distributional. They should not be picking winners and losers. This is the job we give to our elected officials, so it's a function of fiscal authorities. I may not like what the elected authorities do, but they're elected to do it. They favor some industries, that's the way it goes. For central bankers to start engaging in what looks like tax policy, again, as I suggest, risks their independence. So to sum up, everyone cares deeply about climate change. The primary responsibility for enacting policies to mitigate climate, however, rests with fiscal authorities. We need a carbon tax. We need subsidies for research and development of the appropriate technologies. Financial regulators have a role in ensuring adequate disclosure, creating common scenarios, and addressing financial stability risks that arise from climate risks. But when it comes to central bank policy involving interest rates, lending, or balance sheet management, I think getting involved is profoundly unwise. Let me close by quoting my good friend and collaborator, Sir Paul Tucker, who is the chair of the Systemic Risk Council, and many of you will recall was the former deputy governor for financial stability of the Bank of England. Several months ago, when giving evidence to the Economic Affairs Committee of the UK House of Lords, Paul made the following remark. He said, "One thing that is said about climate change and central banking is that climate change could be very bad for financial stability. And I agree. Wars are very bad for financial stability too. Should central banks ration the provision of credit to suppliers of arms manufacturers?" Thank you very much for the invitation to participate, and thank you for listening.
Thank you very much, Steve, for a very interesting presentation. Now I would like to give the floor to Pierre Monat, who is a senior fellow at the Council of Economic Policies in Zurich, Switzerland, and he's also a board member of the Access Forum. Pierre was a senior economist at the Swiss National Bank, where he advised its board on issues concerning financial markets and monetary policy. Pierre will walk us through the methodology behind the Green Policies Tracker. Adrian Fondiago, whom a lot of you who have followed our webinars know pretty well, and Teresa Gecko have done the research on this project. Pierre?
Thank you, Anastasia. Can you hear me well?
Yep.
Yeah, perfect. So thank you very much for the invitation. And when I was preparing this talk, I realized that I think we, and when I say we, it's people working on climate, financial regulation, and central banks or monetary policy are quite a privileged people, because it's a field that I've seen a profound paradigm shift during the last few years, and now, I mean, we went from not talking about this issue to a very active field now. And let me just illustrate that with my personal experience. When as Anastasia said, about 10 years ago, I was a central banker working here in Switzerland, and decided to leave the central bank to join a think tank to look at what central banks could do for climate and also for other sustainability issues like inequality. And you know, when I left the bank, most of my colleagues, when they were nice, would say, "Good luck to you and to try to change the world," a bit ironically probably, but mostly told me that I was going in a dead end, and you know, climate change and central bank have nothing to do with each other. And I think this was the predominant thinking 6 or 7 years ago. I don't know for you, Stephen, but I'm not sure that you would have considered accepting such an invitation to such an event 10 years ago, when no central bankers were talking about central banks. And this has changed dramatically. Now, no central bank refused to talk about climate change. And more than that, they are exploring precise ideas and policies. And sometimes they are even at the edge of implementing such policies. And then, you know, the Access Forum is a vivid example of this interest by central bankers and academics on central banking, financial regulation, and climate change. You know, from not speaking about the issue, we end up this year with a full series of webinars with distinguished academics like Rick van der Ploeg, who will speak later, or eminent central bankers. We had, for example, a panel on monetary policy operation with the head of the Bundesbank research, the head of the ECB monetary policy strategy, and then a senior advisor at the Bank of Spain. And this was purely not, it was not thinkable, let's say 8 years ago. So, and in this series, we also have discussed issues with practitioners on how to manage risk in central bank's balance sheet, on which statistic to use to assess climate risk. We also talked about concrete policy proposals, that how to integrate manage climate risk in collateral framework. We also touched upon the more theoretical issues with academics. We had a nice presentation about how to deal with fundamental risk and use a precautionary approach. Also, seminars on macroeconomic model. So I think this makes a good combination of practitioner and thinker, and ensure that the discussion in the e-Access forum is grounded on real issue, but can also go further and extend to discussion that go beyond everyday operational issues. So I think that this e-Access series is a perfect illustration of the dynamic in this field, and where we have burgeoning theories and emerging policies, and we have engaged practitioners and academics. So this just for you to show that we have seen a tremendous development in the matter of financial and monetary policies in the last years. And that's one thing that we wanted to keep track with the tools that Adrian is going to present to you in more detail later. I'm not going to present the tool entirely. I think it's the users that will find it useful, and there's a lot to play with when you start entering this website. What I would like to do now, in the few minutes that I can speak, is to present a bit the context in which these policy trackers is taking place, how mindsets have evolved about central banking, financial regulation, and climate change in the last years, and present the main issues that are currently discussed when it comes to design the implementation of policies. And this, with that background, I hope you will understand better why we started this tracker, and also how it is designed and organized. So let me first go back a bit in time and to see how, through which door financial supervisors and central bankers have entered the field of climate change. I think there are two key moments in the paradigm shift that I mentioned before. The first one is the speech by Mark Carney at the Lloyd's in London, addressing the UK insurance. So this is a key speech. It really, I think Mark Carney made two statements in this speech that are still valid today, and that have driven a lot of the thinking of central bankers and financial regulators when it comes to climate change. The first thing that Mark Carney highlighted is that climate risks are financial risks. So basically, climate change will have a financial impact on financial institutions. It was a good idea for him to first make this speech in front of insurers, because I think insurers are much more aware that climate change will have a financial impact on them. But I think it goes beyond insurance. And Stephen mentioned earlier that also other financial institutions like banks and asset manager will be impacted by climate change and by the financial consequence of climate change. The second statement that he made, and I think it's still valid and very important, is that financial markets are not good at managing climate risks. There is let's say a financial market failure when it comes to climate, and Mark Carney illustrates that with this the title of his speech, The Tragedy of the Horizon, and he really emphasized the different horizon between climate and when climate will impact, and when the horizon that financial market have, and see that these horizons don't coincide, and therefore give rise to market failure. I think this is one example of the market failure, but this difference of horizons, but more generally, and this has been also acknowledged several times by other central banks now, there is a more general problem of externality with climate change, an externality that is not fully accounted for in financial crisis and in the evaluation of climate financial risk by market participant. The second point, turning point, I think for the paradigm shift was the creation in 2017 of the Central Banks and Supervisors Network for Greening the Financial System, the NGFS. So this group started in 2017 under the impulse of the Bank of England, the Dutch Central Bank, Banque de France, Bundesbank, Bank of China, and Malaysia, if I remember well, and Mexico. And so that was the first 8 central banks that joined forces to look at the issues relating to climate change and central banks. And now, it's 4 years later, you have more than 100 of central banks and financial regulators that are joining this network. So it has really triggered a worldwide movement in central banks. And the NGFS did a tremendous work in raising the issue of climate change for central banks. And they also, I think, made like, they have like 2 lines of works or line of thinking that are very close to what Mark Carney presented in his speech, which is that climate risk are financial risk. And here the NGFS go further. They say that these risks are foreseeable. We know that they will happen, that they are far-reaching. They will affect financial institutions, but household and firm in general. So basically all corners of the economy, and that these risks are irreversible. And so they will happen. Their size will depend on how fast policy are implemented. And this leads the NGFS to a very important statement saying that climate change is climate risk are part of the mandate of central banks through their financial stability duty. So all central banks do care about financial stability, and through this lens, they should be concerned by central banks, by climate change. And the second statement that they make, parallel to what Mark Carney says, is that basically financial markets tend to underestimate climate risk. And this is also being repeated at the ECB level by Christine Lagarde. And so there is here a market failure, and where central banks now also tend to emphasize is that this risk caused by climate change could also be systemic for the financial system, not only for individual banks, but for the financial system. So what have the NGFS and other central banks done in the last 5 years? First, I think they've really become better at understanding the transmission channels between climate change and financial market. There is, I think, a key paper here by the BIS really showing how climate risk transfers to financial risk, and especially showing that climate risk usually show up in the usual risk categories that banks are using: credit risk, market risk, etc. So basically it's not so much a new type of risk; it's a new source of risk for that falls into the usual types of risk that banks. So that makes it much more tangible for central bank to be concerned by climate risk as financial risk. The second thing that they have done, I think, it's also to really improve their diagnosis of risk. So many countries have trying to map which risks are triggered by climate change. The methodology have improved in time. And I will come back to that later, but now central banks and financial regulators have a good view of where are the risks and how big they are. And if they don't have this view yet, they have the methodology to assess that if they want to. The third thing that the NGFS has done is to assess and explore policy options for central banks and financial regulators. And this is important because now the ideas about policies that central bank can implement are there. So for example, they recently published a paper showing everything that is possible with monetary policy operation, and Stephen gave his view about how, if they have to do it or not. I won't take this a view, but just say that the tools are there, and now is a choice for central bank to use them or not. And you know, parallel to exploring policy ideas, the NGFS have also documented what are the practices in the world, and which are the best practices in a sense. And that's something that we would like to also to show in our tools, is to show to keep track of every policy that has been implemented, to document them, so that someone working in a country or in an area can see what has been done somewhere else in the world and get inspired by it or learn from it. Just to give you also an idea of the better diagnosis that central banks now have, with the example of what the ECB did. So the ECB has spent a lot of resources to try to assess where are transition and physical risks in Europe. They've done that through several publications, and recently I think they came up in the context of the ESRB, the European Systemic Risk Board, with a document that really show which region are the most exposed to physical risk, and which economic activities in which countries are exposed to transition risk. So I think, you know, this is a very good example of how knowledgeable central banks are about where the risks are. A second thing that the ECB has documented is that banks are not ready. So they are not ready for climate change. So the ECB did a survey to look at what were the practices of banks in terms of managing climate risk, and they found that banks fall short of you know, supervisory expectation in terms of managing climate change. So again, with these two examples, you come back to the fact that you know, first, financial climate risk are financial risk. We know where they are, and we have a good picture of them, or we can have a good picture of them if we invest the resources in assessing them. And second, there is a market failure, and in that case, it's that the banks are not really ready to manage climate risk correctly. So, you know, that's what has been done as, I would say, good. Now, the main complaint from NGOs or from other people is that no decisive policy action has been taken regarding climate change by central bank and by financial regulators. So this is not totally true. And that's one thing that you can see in the tracker that we will present, especially in terms of financial supervision. So I think, you know, climate risk, financial supervisors have taken climate risk seriously earlier than central banks in their monetary policy operation, for example, and they have started to implement policies. And that's what is shown in the tracker. And these policies, you know, start usually by like soft laws about disclosure, and you know, it's first about disclosure, then about setting, you know, guidelines on how to disclose, making disclosure mandatory in some jurisdictions. So we can see that in the tracker, and when you will see the tracker, you will see that we have identified much more financial policies than monetary policies. So they have done something. But again, this is not enough. We are not enough because we are now at the level where it's about disclosure and identifying risk, but there is no concrete policy action to enforce a better risk management. This is maybe something that the ECB will do, after seeing that banks are not really ready. They have announced that they will probably take measures next year to make bank have better practices in terms of risk management. But even if we had policy financial policies, there are still tools that are not used in prudential regulation, for example. Stephen has mentioned that we could adapt capital requirement. This has not been done. You could, for example, think about systemic risk buffers for climate risk. This has not been done. And often central banks and financial regulators complain about the lack of data for that. Now, this is a concern. Good data are better than, having more data is better than having less data. But I think now we are at a level where the data are there, and it's better to use them than to wait to have better data. And that this has been emphasized by Frank Elderson at the ECB, saying that with the patchy data that we have now, no action is worse. No action is worse than imprecise action in a sense. So we better to use the data, even if they are not perfect now, than doing nothing, especially with climate change. Two words about monetary policies. So as I said, there are less monetary policies that have been implemented. And here I diverge a bit from what Stephen said. I think there are some good ground for central bank to do something. The first thing where they have to do something is about their own risk exposure. Central banks through monetary policy operation have assets, and these assets are exposed to climate risk. And if the central bank copy the allocation of the market, then it falls into the market failure that have been highlighted before, saying that market underestimate climate risk. So central bank to have a sound risk management should integrate climate risk into their asset purchases, their collateral framework, and reflect that. And the other thing, I think they also good ground to have a more supportive action. This is, for example, to reduce systemic risk caused by climate in the future, and basically to support other policies. It's true that fiscal has a larger impact, but a carbon tax solve everything only in textbook. In practice, all policy should be aligned, and here there is ground to do something. Last thing that I would say that one thing that in GFS did, which is good too, is to have other countries and just develop economies where we see practices that differ a bit, and this is also something that we see in the tracker, where we can see that some countries like China and Japan are sometimes more progressive than other countries. Thank you.
Thank you, Pierre, for a very interesting presentation. Now, Adrian is going to show us how we can use the tracker on our website. just a quick note, Adrian is a researcher with the e-Access Forum. Adrian.
Thank you, Anastasia, and thank you, Pierre and Steve, for the very insightful presentations. I just want to take a few minutes to explain to you what you will find on our website, and I will post the links to both visualizations, both trackers, obviously at the end of our presentations. So this tracker aims at combining and displaying all environmental and specifically climate-related policies at central banks and financial supervisors. And geographically, we have for now focused on the G20, on all of the European Union member states, and the Americas, so that includes Latin America. Obviously, we are going to complete this as soon as possible to become a global database of all policies. As said on the outset, the research was conducted by Teresa Geckle, a colleague of ours, Pierre and myself, and we also relied on great existing resources, both in published in research and databases with a slightly different focus that are available online. What is unique to our database and our visualization is it's comprehensive yet focused, and we have chosen these categories that I will explain in a moment. And it offers this very nice visual appeal, and we got some help there also from the Information Lab, a London-based organization. So we structure our data here in these three buckets: financial policy, monetary policy, and additional policies. Within financial policy, you will be able to find, just needed to reload. You will be able to find three categories: credit guidance, prudential, and supervisory policy. The monetary policy, we have divided these into collateral, credit operations, and asset purchases, domestic as well as foreign. And then this additional policies category hosts mainly these own funds policies, so where central banks make decisions, change the composition of their own investments, as well as a change in mandate, something that we might be seeing a bit more in the future. For now, this hosts the prominent examples from Hungary and the UK. The UK's remit, and then there's this other policies bucket. So digging down into these, you already see, and Pierre has mentioned this, supervisory policy is, and supervisors have been most active about climate-related issues, and clicking into this category, you will get, and this goes for all the other buckets as well, is a bit more detailed list of policies with an explanation of what's going on within this policy type. So in this particular case, you see we have 24 policies in the in disclosure requirements, 7 pilot climate stress tests, and fully fledged full-scale stress tests on climate-related risks, 10 surveys of practices among supervised institutions, and 28 supervisory guidelines and expectations issued by central banks and financial supervisors. So let's take an example. Let's click here into this Prudential Practice Guide in Australia. What can you learn about an individual policy through this tracker? You will be able to see whether the jurisdiction is a member, or in this case, the supervisor is member of the NGFS, and whether the jurisdiction is part of G20. You will see the name and the description, which may be more detailed than here if it needs to. You will be able to see when the policy started. In this case, it's only announced, so there's no specific date here. And in case it was amended or has ended already, you can see when. Down here, you will see who's the deciding institution, in this case, the Prudential Regulation Authority in Australia, who implements this, and which kinds of institutions or asset classes are affected by this. Up here, you will see the category of the policy type, and by hovering over it, you will get a description. So this is something that we added to for non-expert users of this visualization. And clicking on this icon will take you directly to the APRA website, to an original policy document. Going on to a map overview, this allows the comparison policy breadth across countries, but also allows you to look into policy depth within one country. So we see here by the slightly larger circle size in China, they have 10 policies. We can directly see into which buckets these policies fall. We can see that South Korea has no policies, no relevant policies in our database. In Australia has 6 policies, and all of these fall into the softer category of financial, and then in this case, mostly supervisory policies. And clicking into Australia will give you a list of all the Australian policies. Both in the map view and in this bucket view, you can also directly filter by country, by whether the countries are G20 members or whether the institutions that we cover are NGFS members. Now, closing, I just want to say this is work in progress. You might find issues here. You might want to add something, especially if you work at a central bank and you find something is missing. In this case, down here, you will find a link where you can just send me an email, and this will prompt a window where all the information that I need is covered. Similarly, if you find issues with the visualization that are mostly functional, you can contact me here. This is only a first step. In the next step, we do want to broaden our visualization. We want to move beyond just a descriptive approach and also look at the impact that these policies have on financial stability and greenhouse gas emissions. Our goal is to also understand the metrics that are used to measure the impact and link this with the existing literature. And this body of literature is already immense and growing, and this is a great segue to the next part of our presentation tonight, which covers climate economic literature. Yeah. Thank you.
Thank you, Adrian. I think we talked enough about policy now, and maybe it's time to talk about theory. And for that, I'm delighted to present our second speaker, Rick van der Ploeg. Rick is a professor of economics at Oxford. He's a research director of Oxcare, and he's a part-time university distinguished professor of environmental economics at the University of Amsterdam. He was formerly at the University of Cambridge, LSE, EUI Florence, and at Tilburg and VU Amsterdam universities. His research interests span macroeconomics, public finance, and development with a focus on climate economics. He has consultancy experience with the IMF, OECD, EU, World Bank, the Asian Development Bank, the African Development Bank, and the private sector. Rick, the floor is yours.
Thank you very much for inviting me. My remit is a bit different. I've been asked to say something about the state of climate economics and whether the academic contributions are fit to purpose for the questions being asked. So, and I will take it as a slightly broader remit. I will focus a bit on finance and monetary policy, but I will look also at the broader questions that are of interest to people interested in the green transition. So I suppose I should be upfront and say what I think. I think we're not in a good place yet. And I think we're in a tipping point where we are getting into a good place. Let me rephrase it. I think, for example, the stuff that central banks are now doing, like all the stress testing, climate stress testing, in trying to identify the risks, are way ahead of what's happening in academia. So I think what we need, and this is the summary of my talk, which I will try to keep to my 15 minutes, is one, we need better questions. Always need better questions. That's the first bit of research, to have the right questions. Secondly, we need better data. And third, we need better models. And I think on all of these three, we can do better. So it is true that if we first look at the questions, that most of the questions phrased in the economic literature, and also in the literature more generally on climate policy, the type of stuff done by integrated assessment models, as well as in the more academic literature, has a tendency to focus on kind of ideal policies rather than policies that are politically feasible. There are some policies, I mean, everybody's saying carbon pricing, including myself, but maybe an emphasis more on more pragmatic policies, maybe like fee-bates, where you kind of try to match the pricing or match the subsidies, let them depend on the difference between the emissions intensity of a particular firm and the emissions intensity of the market, or even better, the emissions intensity of the three best firms in their sector. So that's a more pragmatic policy, second best, but it may do a hell of a lot better in terms of politics than the type of ideal policies we often advocate, and will then be political harakiri for policy authorities. In my view, that is the reason why central banks are way ahead of governments in terms of preparing themselves for the climate transition, in terms of making central banks and regulators fit to deal with both physical risks and financial risks. The European Union has made a big step forwards under the lead of Frans Timmermans on doing the Green European Deal. But national governments, particularly in Europe, many governments, of course, there are always some exceptions, like maybe Sweden or maybe Norway, but many of them are lagging behind. Again, the UK is not doing too badly, but Germany, the Netherlands, for example, countries I know reasonably well, are way behind what's happening in the financial authorities. So we need better questions, and I think, and I will come to that in a minute. It's that they should not just deal with what we think ideally in the textbook should happen, but that deal with the dirty nitty-gritty of practical policy making. Secondly, I think we need much better data. I know that if I look at the models, the damages from global warming are typically way out of date. They are sometimes 30, 40 years out of date. They have not been re-estimated. They're very partial, and it's usually based on bad econometrics. This is not just a critique of people like Professor Pindyck of the Massachusetts Institute of Technology, but it's just anyone with common sense can look at it. If I show it to first-year master students in Oxford, and they show you the damages that have been used in the climate literature, they feel very uncomfortable, and if they're very polite, they won't say anything, but sometimes they say something very rude. Now, thankfully, there's a lot of extra work happening now on getting better data to get better estimates of the effects of global warming on the economy and on financial markets. So there's the Climate Impact Lab run by Professor Solomon Hisham, and of course many other people like him, including people like Michael Greenstein and others, are using very granular data. So they're using data on very small spatial effects, because the effect on global warming differs very much, maybe even if you go 10 kilometers away. And they're looking at also over time and over a very detailed spatial granular pattern. Other economists like Tony Smith in Yale University, or Rossi Hansberg in Princeton are also following that frontier, but they're not as far on the detailed data. And Nordhaus himself is beginning to do that as well. But none of that is really properly reflected yet in the data. But then if you have these very granular data, so they're typically looking at the effects on global warming damages, but they may also look at the effects on conflict resulting from global warming. They may result in the effects on migration as a result from global warming, where people leave very hot spaces to cooler places. And then now beginning, there is now my colleague, younger colleague, but fantastic what he's doing is Ben Caldecott at the University of Oxford is now starting up a similar initiative on trying to get the data on a very granular level, which can then be used to really assess physical risks, which are relevant for insurance companies and banks. So really what we really need is my first point is we need really much better data at an extremely detailed level, at a very granular level, and properly done. Secondly, what I didn't say is once you have the better data, we need better econometrics as well. I'll be very brief on that. So far, Most people have estimated damage functions and other effects of global warming using, in the old days, cross-country econometrics. But cross-country econometrics has been completely discredited as leading to misleading estimates and things like that. And yet most of these models are based on cross-country estimates. So what we need is more better identification and a better, much cleverer work on not just identifying some correlation, but identifying the causation. So that's of course the bread and butter of all good applied economists. So we might think of things like discontinuity regression design. We may think of using twin studies, but some way or another, we have to use the best recent econometric techniques to move from correlation to actually being able to say something on causation effects. And even simple question, even the climate literature, we now see an increasing event of, we've seen floods in Europe and things like that. I remember in Germany and Belgium and things like that. And then people often say in the newspapers, we get more frequency of these extreme events, weather events, because of global warming. Well, the jury is still out on that. People are still doing very detailed econometric work on that to find out. This is the attribution question. And there's no definitive answer on it. At most, we can probably say that with global warming, we do know that the events may not become more frequent, but they do become more extreme. So anyway, we need more work on that as well. And that requires better econometrics, better methodologies to doing it. So the old-fashioned approach where almost 9 out of 10 papers I get to referee on climate economics, they don't do any data or econometrics. They just make up numbers, and then they got a word for it. It's called calibration. And I myself have also been I'm guilty of that as well. But it's of course not proper science. I mean, a real scientist will laugh at it. So we need so we've got this. So we have this tendency that we need to get better data, more granular data, trying to get better at causation. What's the real mechanism driving a result? So often people, for example, if you do vector autoregressions, so some of you have heard of that, that's of course very nice to show some correlations. It's basically a very sophisticated way of showing correlation, but it doesn't necessarily mean that you got a good idea about mechanisms. So and thirdly, we need better models. So we've got these. So it reminds me what we have very much of what we had in the 1970s. When I started my career under Sir Richard Stone, who got his Nobel Prize. There were all these people like Lawrence Klein in America, and in the UK it was Richard Stone, and they had these huge econometric models, Keynesian econometric models. And one of the first exercises I did is if you did a model reduction exercise, it could just be summarized by 3 or 4 equations, and you got at least the aggregate outcomes pretty accurate. Now, we are now in a similar situation that we have these huge, very, very, very large integrated assessment models, sometimes thousands of equations, and even the integrated assessment models themselves, just an ordinary member of a team, may not know the full details of every bit of the model. So there's a tendency for people to kind of, in economics, to move away from that. And to, if you want, to move towards smaller models, which are specially designed to ask specific questions. So, for example, Glenn Rudebush, has done fantastic work on the term structure and how that might affect also the way we think about climate policy. People. So so you don't always need a very large scale model. So I've seen models to look at, for example, just like after the global financial crisis, people said macro was not fit for purpose. Now you could say, is the macro we have at the moment, is it fit to purpose to answer the questions for example, default risk, systemic risks, and the financial things central banks are looking at. So I'd like to suggest, to conjecture, just to be the advocate's devil, that we haven't really got proper models yet of that systemic risk, of systemic financial risk in a proper macro model, which is micro-founded and which passes the rigorous standards of modern macroeconomics. I don't think that's bad. It just means it's exciting, and there's a lot of work to be done by young, bright people. It's also the case that most of the large models we use for climate policy analysis have got very, very rudimentary financial sectors. So they cannot be used to ask those questions that central banks and financial regulators are interested in. At the same way, they cannot really be asked to ask the industrial organization of the micro questions. Should we use, for example, prices or quantities? A typical thing that's been often addressed by Martin Weitzman, unfortunately deceased only recently. I don't think the models we have can be used to answer those questions properly. So typically we then go back to theory, but we don't have a practical, pragmatic models to answer those questions. Similarly, often when you're talking about, say, green quantitative easing, as some people have been arguing for, people like Paul Klemperer, the big auction expert or mechanism design expert, they've looked at special auctions to bring those in the most efficient way, introduce that liquidity or introduce green quantitative easing into the economy. Well, I don't think these are things that can be done with the most of the models we've been using. So I think we need either better models or we need better models to ask specific questions. So really the model should not precede a question. First, what's the important question we're interested in, and then what kind of model are we going to use for that? So for example, the final point about the model aspect is that many of these models are not so good on doing income distribution. Both income distribution between countries, income distribution within a country, so income distribution across different incomes, but also across different types of households, but also about income distributions across different generations. So it's only recently that the famous overlapping generations professor, Larry Kotlikoff, did a paper on looking at intergenerational win-win situations, using and published that only last year. And that was an immensely challenging computational task to find policies that benefit all generations. So the argument is that if you put forward a climate policy, then typically that hurts the current generations and benefits future generations. So the thing is, can you look for transfers? So the idea is that you would run up a government debt, and then you would give that allows transfers from future generations to current generations. And then you have to have, so we had about 50 generations in this model, and you then actually ensure that all those generations are better off. Of course, you would really want to have models where you have different countries or and then you would ask the same questions. You want to have policies that benefit not only some countries, but all countries. So you want to look at second best policies, politically feasible policies that basically don't make sure that give you a majority in the parliaments today, and actually will also make people better off. So I think in view of the time that I don't want to spend too much time of you, I've got much more things to say. I'll leave it at this. So the final point about the models, one more point, that's something I can make quickly, is that, you know, financial risk is all about risk. So we are interested in tail risks. But we don't know how big the risk is. We don't know whether the risk is temporary or permanent. We don't know when the disaster will happen. So we have a lot of uncertainty. And I think most of the models I have that we've seen don't really allow for uncertainty properly. So what practical policy making does, and the Network for Greening the Financial System should deserve credit for that, is they say, okay, the academia are not yet up to scratch that. So what we do is we do scenario analysis. So say, but what happens in the worst case scenarios? Will the financial system collapse or not? And they do these climate stress testing. So sometimes then the pragmatic approach is better if the theory and if the academia are not quite up to speed yet. Thank you very much for listening.
Rick, thank you very much for a great presentation. I guess when I said at the beginning that the bulk of the work still lies ahead was a real understatement. I would like now to give the floor to Emanuele Campiglio, who is an associate professor at the University of Bologna and a board member of the Access Forum. In addition, Emanuele is a scientist at the RFF CMCC European Institute on Economics and the Environment and a visiting fellow at LSE. He will walk us through the methodology behind the literature tracker. Esther Shears has done the research for this project. Emanuele.
Thank you, Anastasia. So before leaving the floor to Esther, who will give a more hands-on tour of the research tracker, let me say a few words about the classification tree. So we are interested in the literature at the intersection between climate change, transition, macroeconomics and finance. And this is a large body of work. It's expanding and it's multidimensional as well. So we thought we needed and we wanted to offer to interested researchers some key dimensions, some axes that we could use to classify the literature with and orient ourselves in the literature. So the result of the process is the configuration that you see on the screen. We started by splitting the literature in these two broad areas. The first one that you see on the left is directed at understanding climate-related risks, and the second on the right is instead aimed at understanding the ways to address these climate-related risks. And both these areas, we then identified three main categories of research within the areas, and then each of these categories is split or not in certain subgroups or branches. So starting from the left, so the understanding climate-related risks area, the three main categories that we identified are conceptual frameworks, physical risks, and transition risks. So conceptual frameworks aggregates all the literature that develops the conceptual and theoretical foundations of the links between transition and physical and liability risks and macroeconomic and financial dynamics. Physical risks, as the name says, focuses instead on physical climate risks. And in this case, we split this body of work in two subgroups, depending on the methodology that the paper implements. So we have an empirical subgroup, and this is where you find papers like understanding things like what is the impact of extreme weather events on the price of municipal bonds, while the other subgroup, the modeling subgroup, uses static or dynamic modeling techniques or analytical or quantitative models in order to understand the key relationships between the different variables. So in a more quantitative way compared to the conceptual framework category. And this empirical versus modeling methodological dichotomy we applied also to the category of transition risks, which of course are the risks related to the transition to a carbon-free economy. If you move to the right, the area address climate-related risks. In this case, we chose three different main categories. So we have institutional analysis, policy analysis, and prospective modeling. Institutional analysis looks at institutions in an institutional perspective, so gathers all that type of literature. And within this category, we then divided the papers looking at private institutions, so banks and investors, even consumers, and the public institutions, the second subgroup. So here we have all the work on central banks, governments, financial supervisors, development banks, the interaction between them, what they can or cannot do, the institutional boundaries, and so on. The second category is instead focusing on policies. More directly. So here we split depending on the type of policy that looking at. So we have a first subgroup looking at financial policy and the second subgroup on monetary policy. So for instance, any research, so here this category applies both to the policies that have been implemented already, so in a sort of ex post evaluation manner, but also to policies that could be implemented. So, for instance, any proposal on how to green quantitative easing, many are coming out recently, so they would all fall into this monetary policy subgroup of the policy analysis category. And finally, we have the prospective modeling category. Here we gather all the literature that uses dynamic forward-looking modeling that explores future scenarios or identifies optimal policy paths. And in this case as well, we distinguish between a fiscal policy body of work, which as Rick was saying is quite large, that has to do with carbon taxation and carbon pricing, and the second subgroup that has to do instead with monetary and financial policies, which is more recent. So this is the overview, and this is what the researchers or any interested people can find when they land into the main page, the homepage of this research tracker, and hopefully this will help them in orient themselves and find what they are looking for in a quicker way. So clicking on each of these boxes essentially allows the researcher to already go where they want to go. But before clicking any boxes, let me now leave the floor to Esther Shears. Esther is a PhD candidate at the Energy and Resources Group at the University of California, Berkeley, and she has been the main mind and arm behind the development of this tracker. Esther?
Great, thanks Manuele for introducing this visualization and the classification structure. I'm going to spend the next few minutes before the Q&A session just explaining how the literature is collected and coded and demonstrating how to use the Lit CMF tracker version that is currently available on the EACCE's website. So the literature coding process consists of first the literature collection and then the reading, synthesizing, and coding of the research itself. The initial collection started out by organizing citation lists from some relevant literature reviews that we identified. But as the classification tree structure developed, we conducted additional publication searches based on the topical focus and the methods focus of the research space. We also wanted to make sure that we included not just peer-reviewed academic literature, but also working papers, reports from central banks, and other high-profile public reports, as this field is expanding so rapidly and the publication timelines are much slower. Next, we move to the reading and coding portion of this process to create the data set that the visualization is based on. The data set that we developed includes all the citation information for the publication, as well as some variables that describe the research work itself. So now let's move on to how to actually use the Lit CMF tracker. So on this classification dashboard, which is the home view, you can see how we divide up the research space. As you hover your cursor over each box, you'll see a brief definition of what these different research groups are. And if I wanted to explore a specific subgroup of literature, say physical risk empirical, just had to load. I just click on that box, and a table of literature included in the subgroup will appear below. So to exit that table view, I simply click on that box again. But now if I wanted to look at a broader selection of research that includes one or more subgroups, I could either click on this large umbrella of understand climate-related risks, or I could click on one of these broader research groups such as transition risks that would include both the empirical and the modeling research in the transition risk group. I could also select multiple boxes in the subgroups by just holding down the command key as I click additional groups. So besides this literature hierarchy, we also have this control bar off to the side to help filter one's search for literature. I can select that I want to look at only published peer-reviewed research or only public reports. I could select on the geographic focus of the research study, as well as the type of method, whether it's a literature review or a data assessment or something else. I can also text search based on a word in the title of the publication or the author name. And then there's also a citation range bar if I wanted to filter to more highly cited papers as well. So now let's say I wanted to search for a peer-reviewed publication that had a geographic focus of just the US. So I would just click published on the publication status, and then into geographic focus, I could simply click the US. Down. So you can see that all the other research boxes disappear, and that's because we only have the physical risks and empirical literature fully coded at this point. And if I want to see a complete list of the papers that meet those filters, I just click on that box, and now I can scroll through the papers that have a US focus. For a final example search, let's say I'm interested in looking at research on real estate prices. I could type in real estate in the title if I think I have an idea of what paper I might be looking for under title, and I can just text search that. Loading 1 second. And then you'll see the list of papers that appears. Now, if I want to explore one further, say this paper, does climate change affect real estate prices? I can click this link box to explore further. And now this will take us to loading. Pause. It will take us to an individual, okay, here we go, individual publication information page. And this outlines the citation information of the publication like so. And if I wanted to see if I could access the document myself, I can click this icon and it will take me to where the publication is hosted. And I could download that PDF if I had access. Down below, you can see the coded descriptive features of the publication. So this will include, features of the method itself, the year range of observations, any geographic focus, the scope of the dependent variable or the unit analysis, and the climate impact examined in the publication, and what the effect of the climate impact is if it's specified in the paper. We also summarize the publication's data sources used in their analysis to give a little bit more detail about the paper. In future iterations of this visualization, we plan to expand this page view to include summaries of the key findings and a few other methodological notes. So to navigate back, I just click back to the classification tree. And this last part of the visualization that I want to very briefly describe is the heat map dashboard. So first I'm going to unfilter what I had selected in before. Hopefully this will take us to our main view. And then I'm going to click the heat map dashboard. So as you can read from this top description, this heat map illustrates the diversity of research in the understand climate-related risks, physical risks, and empirical subgroup. The selection of papers in this subgroup is divided out by climate impact and these groups of dependent variables. Similarly to the classification tree, if I select a box a table detailing the publications in that group will appear below. And you can see from this selection, the actual specific dependent variable, in this case, it's property price for these 4 papers is listed out, along with the specific climate impact in the paper and a few other of the publication details. The control panel works the same way as the classification tree, where I can select on publication status, geographic focus, method, citation count, and a text search under title or author. And as I add in filters, this publication count number will also update. And if I want to explore multiple groups, I can, again, simply hold down a control key on my keyboard to select a few boxes if I'm interested in. Or additionally, if I wanted to look at, say, all papers that related to debt and equity related dependent variables, I could click that header and see the table updated with all of the literature under that group. So scanning this list, I could kind of narrow down to a specific dependent variable that I might be looking for. If I wanted to explore, say, something about municipal bond issuance cost, I can click this link, and again, it will take me to this individual paper view. So I can scan the details of the paper. I could see if I wanted to download or access the paper myself. And finally, to return back to the heat map, this back to heat map button should take you there. So just to wrap up by highlighting what's to come, as was mentioned before, this visualization is still in the process of being built. So Currently, we really only have a complete coding and visualization set for the physical risk empirical group, but in the coming months, this visualization will be updated as the literature coding process is completed for the rest of the research subgroups. The heat map dashboard will also be updated as well to enable users to visualize the other research subgroups. And finally, we welcome any feedback about this visualization while it's still in the process of being expanded. And so thank you so much for your time and attention. And I believe we will now turn to the Q&A portion of this event. Thank you.
Thank you very much, Emmanuel, and thank you very much, Esther. We have a couple of questions. Two of them are for Steve, actually. One question is, by central banks, not the Fed, buying corporate bonds with liquidity and credit quality criteria, are they not already picking winners? Did they just pick the winners of yesterday, but they're not picking the winners of tomorrow?
Let me make a couple of very quick comments because I know we're going to run out of time. First of all, in direct answer to the question, I'm extremely critical of what central banks have been doing in their bond purchase programs. I don't believe they should be buying privately issued bonds at all, much less bonds that are issued by carbon intensive industries. As Pierre rightly pointed out, market neutrality in the case of the bond market is neutrality with respect to legacy industries, which tend to have large carbon footprints. So I think that's something that we can all agree on. The second part, for sure, that's a fact. Whether they should be buying corporate bonds or not, I guess, is an issue. I think that if you do decide to do it, you get into trouble. And I have been and continue to be extremely critical of that practice, and hope that central banks can stop doing what they've been doing and buy only buy government bonds. A related issue to this was the risk weight issue. There was a question about that as well, which I saw, about whether or not regulators shouldn't impose risk weights. I guess the answer to that is sure, they should. And they could do it in principle in the same way that they do for credit risk. They could have climate risk ratings, but we do need climate risk ratings. So I think the first step in that is to have climate risk ratings, which are on the horizon. And then once we do that, we can have similar standardized, because you're going to need standardized methods for doing this, not internal risk rating methods. It's going to have to cover all banks, even those that aren't among the 30 largest in the world, which are really the only ones that use internal risk models. Finally, I just want to make sure that in your, at least in your mind, in your discussion, I hope that everyone can keep separate the different jobs that certain central banks happen to do. Some central banks do regulation and supervision of the financial system, not all of them, but that is a different job from monetary policy. And regardless of what you may think of my conclusions that monetary policy should have nothing to do with climate, regulation and supervision should, regardless of who's doing it. But please keep those separate in your mind. Thank you.
One more question for you, Steve. You mentioned that the move towards global disclosure standards and unified stress test for banks was desirable. When do you see this happening?
Well, first of all, I think it's not just desirable. I think it's essential. And I think, again, most of us would, at least I know that having listened to some of our colleagues, that they would agree with that. I think it's very difficult to say when it's going to happen. I hope it happens soon. I know that in the UK, there's certainly a climate stress test that's part of their biennial experimental stress test process that's occurring in 2022. I wish everyone would do it in 2022. And I hope that they start. On the disclosure front, I think that this is unfortunately likely to take way too long, because I don't think that we have proper standards yet.
There was another question which Rick already answered, but I thought it was interesting to mention. And that had to do with whether central banks are ahead of themselves in terms of their climate-related efforts. Rick, would you like to answer this question online? Oops, you are muted.
There we go. It's a great question because on the one hand, you could argue it's great that they're so concerned about climate. They're doing all this climate stress testing. They're thinking, how to safeguard the economies, the financial systems against transition risk and physical risks. And in that sense, they have to move along because they have to be pragmatic, even though the academia is much behind. As I said before, I think the best financial economists are only in the last 2 or 3 years beginning to think about these issues and making some great contributions. On the other hand, I agree with Steve that sometimes they may be getting ahead of themselves in using monetary policies to solve the climate problem. That's of course completely ridiculous. So it may already help. For example, I know some work by Monica Piazzezzi that she looked at the quantitative easing programs, and that they actually so far have been quite dirty. They've been quite carbon intensive rather than carbon extensive, rather than no low carbon stuff. So one thing they could do that if you do quantitative easing, and that's a debatable question in itself, that at some point we have to get rid of this addiction, that at least try to do it in as green possible way. But I would put a big warning out there that those people who say that we should use green interest rates, green Basel ratios, maybe we should not have green Basel ratios, but maybe we should have more tighter policies on the carbon intensive firms. You don't want to have looser requirements for green firms, because then you may make the whole system more volatile. These are two very different things. So you have to look where the market failures are. Again, economics can help, but of course, policymakers have to move ahead of where academia is, because problems can't wait until academia suss themselves out. So a great question.
And on that note, we are finished with our schedule. We managed relatively on time. I would like to remind you of the 2 upcoming webinars. One is on September 13, and our speaker is Hélène Ray from the London Business School. The other webinar is on September 27th, and our speaker is going to be Roland Benabou from Princeton University. Thank you all very much for joining us today, and I'll hope to see you soon in our next webinar. Thank you very much. Bye-bye.
Thank you. Bye-bye.
Thank you. Bye.
Bye-bye. Thank you.
Thank you.